Welcome to the Options Income Blueprint Weekly Income Report. On July 18th, 2022, this is Michael Schulman. Our next session is tomorrow, Tuesday at 11. As always, reviewing trades and results from last week, a brief discussion of the market we face for the rest of earnings season, maybe a little bit beyond. And again, as we did last week, I want to break apart a trade in a company probably very familiar to you, Roku. So we were busy. We took losses last week. The big loss was in Foot Locker. I still don't like the way the stock was trading. It is not just that it is a consumer discretionary stock, and while there was a bump in that sector a bit last week, the bump wasn't big enough. I think it's in passing. I think the sector is going to be under more pressure from a trading point of view, but from a fundamental point of view, uh, Foot Locker seems to be more vulnerable than the actual manufacturers of shoes between the direct-to-consumer, which they really have not put themselves into, which they should have, and just the simple growing frugality of people. We did a shoe company last week in Crocs, and frugality speaks against the higher margin shoes that are very critical to Foot Locker's success. We had relatively decent to relatively small to relatively non-existent rates of return, which are the most important thing for us when we go and take a look at the positions from last week. There were rolls, and as you see, I've been parsing out the rolls and not on purpose, but just based on events and based on cash needs. We're not rolling all our open positions at the same time. So because we took a loss, we're counting that loss against our capital, the cash coming in, et cetera, et cetera. Now, the reason I use both, you can view it in two ways, which is if you have a more sophisticated way of tracking, you can say, this hit my portfolio, so I took capital out of my portfolio, and this doesn't reduce the actual way of measuring my performance, if not necessarily success, in terms of generating cash. It's just simpler to say, well, last week to goal we were negative, and we were negative because we took a hit, and you can decide whether you want to say, well, I've made 2,000 in cash this year, I gave back 300 or 200, so I made 1,800, or you can say I still made 2,000 in cash, or my capital base is down. That's an artifice. It's just how you would measure your own tactical skill. The net of the day is the dollars of the dollars, and there was a loss that needs to be put somewhere. So there, as I said, the overall performance on the new trades and the roll trades. The roll trades, because of the way the market was behaving, are a bit more designed to capture appreciation, which explains why I made recommendations where there was less cash coming in. So one of the way, again, by tracking cash as opposed to portfolio value, when we're doing this week by week, your portfolio, we don't do things as a portfolio here. The bottom line is the captured appreciation doesn't show up. So again, it's up to you how you want to track this. We're going to still continue to focus myopically on cash. So let's take a look. The CPI and for the most part bank earnings are behind us this morning. Goldman Sachs and Bank of America both announced. Bank of America had a sort of on target, slightly better than expected performance due to increasing profits from their loan area. They're the biggest retail bank in the United States. Goldman crushed it on fixed income trading, which was expected, but not as well. No one expected them to do as well as they did. We'll see how they trade for the next couple of days. And what also happened last week was there was a hot CPI number. Market reflexively sold off for a few hours. And then it didn't, because underneath it is this funny term, UIG. It's called the underlying inflation gauge. And that really is what determines Fed decision making. The Fed economists and the research staff take a look and say, well, this is really what is core, which will drive consumer behavior. And that was actually down a tiny bit. And so the bottom line is the market absorbed that and said, well, maybe the Fed's not going to be as aggressive. The market went down when there were hints, rumors. Somebody made a comment, some Fed governor, that there might be a 1% raise. Over the weekend, it was made clear that there's going to be a 3/4% raise in July and not 1%. Um, One of the things common to all the major banks, Citigroup, Goldman Sachs, Citigroup, Bank of America, Morgan Stanley, they're all suspending their stock buybacks. And while this caught the street a little bit by surprise, it was not wholly unanticipated. And if you looked at headlines in the banks and it said they lost money, excuse me, they didn't meet expectations, it was because of loan loss reserves, not ongoing cash flows from existing businesses. And so the question now is, what else is earnings going to bring? But that has to be set against the backdrop that professional investors and traders, I guess I'm a pro, maybe you're not. Professional investors and traders are human, and we have a darkening mood across the developed world. It's just dark. It is post-pandemic blahs and blues. It is constant headlines about Supreme Court decisions, about gun shootings, about Ukraine, about Italian government falling but not falling, about inflation. It's all dark. And it preys on everyone, not just individuals trading as individual investors. And so if you put it all together, it's a very heavy weight, and it matters. It is not insignificant. So if you have good news and you're feeling dark and you're a professional trader, it may be seen as bleh or meh or it's mediocre. If you have great news, it may be seen as good news. And if you have news that says we met expectations, it can be considered bad. You have to put all this in with the event of the Fed announcement, which there won't be another one. There's one at the end of the last week of this month, and the next one's in September. The concerns about profits, the concerns about a recession. So those are the factual ones in the real world. So they do combine, they intersect, and they add up to continuing bearish sentiment. On a happier note, I loved this trade because it's more of a trade than an investment. I mean, usually I'll look at a General Motors or Bank of America saying you can own them forever. If you're conservative and you only want to do 15% a year, you own the shares, you sell calls, you don't think about it. Apple's, the companies like that. But we also trade anecdotally and opportunistically on companies that are great brands. They have what Warren Buffett calls a moat around their brand, but they're not monetizing their business as much as Wall Street would like, so that the stock can trade in a very erratic way, which means it's much better opportunistically as a trade than something I would say, let's stick in it for 52 weeks, week after week after week. Now, they're increasing in importance because of what they're doing. And what they're doing is, if you've never used Roku, which would be they're a verb. They are the middle company between a new streaming service or an old streaming service like Netflix and you. There are Roku remote controls. There's Roku embedded in most televisions, if not all. And you can go to a Roku remote and you can type in the name of a movie or a television show. It will tell you where, on what streaming service it can be found. And they generate money from licensing fees. They generate money from advertising on their own network with 50 million people or so. They generate commissions by selling services. You want to watch NCIS or whatever, and you're not a member of Paramount, you subscribe to Paramount for $6 a month, Roku gets a cut. But it is crushed post-pandemic. It was always volatile. It's now almost hyper volatile, if there's such a term. It's very liquid. So when you look at premiums, we were looking at a fairly conservative trade with a 0.9% potential return in 11 days or 29% annualized. Why so low? Because we try to start at 32. Well, the answer is simple. The strike was 19% out of the money. So the reason I mention that is that many of the people who trade look at the trading and the premiums and charts first. Bad mistake. And then they go to the fundamentals that I just discussed. So I set up the information in front of you based on how it is done with an anecdotal trade, or how it is done from people who aren't paying attention to fundamentals. But the bottom line here is you need to do finding Roku first. I'm not trying to cover for a flip in the slides. This really is what's what. is that most of the people that I get feedback from in emails and live will go, oh, this premium's great, why aren't we trading it? That's a mentality, especially if it's a stock that they've heard me say, let's trade it anecdotally. But the bottom line here is the fundamentals are very sound. The price earnings multiples high. There's no E right now in last quarter. Um, and here's a screen capture, and you can see that this is both the problem and the opportunity, is that this isn't being monetized enough. So that's why it's volatile. It does move earnings event to earnings event. There's a clear knowledge they don't have competition. There's clear knowledge there's this fabulous brand that is protecting of itself. But on the other hand, can they make as much money as they should, which they haven't been? And so all of these represent potential income streams for them. But the bottom line is Wall Street's uncertain, and when Wall Street's uncertain, you and I can make money selling puts and calls. So that's about as ugly a chart as it gets. This is the post-pandemic Roku going from $491 a share, which where it did not belong, to $73 in June. That's a 1 year chart, and I'm smiling as I say this is because if there's a post-pandemic crash, there are a bunch. Peloton and Zoom and Teladoc and DocuSign and Roku and Netflix. Uh, but Roku's business is its market share gains are their gains against no competitors, and so the determination for me would be that as the market got quieter, it's still bearish sentiment. We saw stability, and it may be time to trade the stock. If you take a look at their financials, we go back to the uncertainty. I won't walk through them. You can see they're really not making any real money worth mentioning, given the market cap. So the chart in this go along, and now the question is the flattening out in the last month in the low 80s, high 70s, reflective of a proper valuation given the growth here that you see, even if it's not a growth in profits? And it is. And so they've said that their revenue dip was due to supply chain issues, and that was agreed to by Wall Street. And the growing complexity of what Wall Street sees leads again to those bounces back and forth. And I'm kind of optimistic that the company, if not necessarily the stock, that the company will do well in the long run. The bottom line is, though, you trade this when the charts say to trade it, you know you're not going to get into super deep trouble. And here's the reason. So you're looking at the 30-day low was 80 bucks. And you saw that we had dipped down to 72 something. That was the yearly low. Well, we sold a $70 put. And we sold it when over here we were at 86.76. You can do the math. That's a gigantic gap between the share price and the put price. And here's the simple math. Our goal is a 0.5% a week. And that would be 26% a year because of rolling and losses and what have you. I try all the time. The recommendations have a plan or right up front to do at least 32% annualized return. So the plan here was to close early, always, or to roll it up, meaning we sold to 70. If the stock stays at 86 or in change, we buy back to 70. We sell the 75, and then maybe 2 or 3 days before expiration, if the stock is still in the 80s, maybe we buy back the 75 and we sell the 77 or the 78 or the 79. So you could go either way, but the goal is still to be considerably above that 32% target annualized return. And so the plan is to stick to goals, and the plan B is to stick to goals. So I was hoping that plan A was really to roll it up and generate more cash. That's what we're all about here. But plan B was to stick to goals, which means if we get a potentially high annualized return, we're out. So here's the original trade. This is the alert. All the details you just saw are here. And it was an 11-day trade, putting on a Tuesday to expire a week from that Friday. And the 29% speaks for itself with, during our live sessions, the verbal admonition that I really would like to roll this up with some frequency and generate more cash. Well, forget plan A and go to plan B, which is stick to the goal. Plan A and plan B are, of course, always stick to the goals. And here, let's make hay while the sun is shining. It's a cliche, but it's true. And so if you take a look down here, um, you're looking at a 61% annualized return and a freeing up of capital for the next trade, either a next recommendation coming from optionsing a blueprint or something done in your own portfolio. And this kind of quick movement is something, of course, that is quicker than we did last year, but because of market conditions, this is what we'll be doing for a considerable period of time. So we did book, I want to answer questions. We did book a loss on the Foot Locker position based on the fundamentals of the company plus the way the stock was trading. I just didn't think we were going to hit goals. And I didn't want this to be dead money for 6 months tying up your capital. We put on the trade at a higher, the stock was considerably higher. We sold something almost 10% out of the money when we sold the 27.50 put. It was because of earnings from Nike, but the street's concern both about retail consumer, about consumer overall, hit after the Nike earnings announcement. I think some of it's misplaced, but you can't argue with the street. They set the price. And if you're assigned shares, sell calls close to the money. This stock is not shown it can punch through 25. I would keep selling something close to the money. Don't target appreciation above 25, barring a major uptick, either in the consumer discretionary sector or the market itself. And I hate taking losses, but there really are times to move on when either one or both things are going against us, the fundamentals of what the company is facing and doing, and the market itself, and both we're saying let's get out. So we have more earnings ahead. A lot of mega tech companies, now they call them tech companies. Google's a marketing company, Facebook's a marketing company, Netflix is a media company, Apple's a tech company, but they're all announcing, and I think they're going to set the stage for market movements in either direction. There's bearishness about forecasts for Q3 and Q4 growth. There is a belief the current consensus estimates for the S&P 500 is earnings will grow 9.9% this year. That's too high based on most of the economy and consumer spending, but tech will let us know whether it's too high or not. For example, Apple may see reduced earnings less than revenues less than expectations, but they may see margin expansion. So we'll see how it goes, and I think tech will be very important now that the banks are pretty much behind us in having the street say, okay, we are going to hit our 9.9 or more, or we're not. And that could determine which direction sentiment underlying the market goes. And but I would trade the market as if the current stability doesn't last. I mean, that's why you sell $70 strikes when the stock's at 86 bucks. Lower your expectations for initial trade and be ready to get out sooner. This is Michael Schulman. Thanks for listening.